From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, July 15th. You're listening to the Macrocast. This is Tony Fratto with Hamilton Place Strategies. Brendan Walsh, John Fagan, Markets Policy Partners are partners in this enterprise. Guys, the macro data doesn't stop coming, does it? We've had a lot more this week. Big questions about where the direction of the economy is going. Maybe directionally we kind of have it, but scale, scope, and speed, I'm not really sure about. We have prices to look at. We have commodities to look at. Where do you guys want to start?
Yeah, this week was about the CPI, the consumer index, and producer price index data. And this was a highly anticipated set of releases, given the fact that the May numbers came in and really shook up the markets. There was an expectation ahead of the May CPI number that inflation had peaked out in March and, was going to still be high, but the trend was going to be going in the right direction. And the May number disproved that, and it was genuinely, induced some significant volatility. And so people were really biting their fingernails coming into the June number here, and it was
they're going to bite them down a little bit more, right?
Yeah, and I think it's fair to say that the markets have digested this week's inflation numbers maybe a little bit better, and that's because some of the shock factor has worn off, and we have seen some very mixed signals on other price indicators. Even if you're talking about the panoply of inflation metrics that the Fed has now sort of put out there as things that they're going to be reacting to, whether it's an New York Fed expectations, today's University of Michigan expectations, the CPI, the PPI, the PCE price index, and what is supposed to be the Fed's favored metric, the core PCE prices.
Yeah.
These are all elevated, but in I think important ways, pointing in kind of different directions. And then you look at the underlying factors, the things that have been driving it, like used car prices, food prices, and you look at agricultural commodity prices, metals prices, these inputs, those are all down a lot. Gasoline
and
prices
by a lot. I mean, specifically, aluminum's down 40%. Chicken wings are down 38%. Chicken wings, yeah. We had a big shortage of chicken wings in the pandemic, and that supply chain has come loose. Wheat is down 30%, 37%. Crude oil is now down, 25%. Yesterday, we actually had the biggest single day drop in retail gas prices since 2008. So Americans are spending $177 billion less on gas than they were 31 days ago.
So is that? But
we're all freaking out about inflation, but actually, if you kind of look around, all you're seeing is actually deflation in a lot of very key areas.
Or at least disinflation.
Disinflation, yeah.
Yeah, and are they? But I mean, obviously, that's a demand story, not a supply story, right? We're not seeing prices move on all this. Yeah. Totally demand story.
The copper was well above $5 a few months ago, and now today, it for the first time, a few months, it's trading below $3. And copper is a very simple one. You only use copper to build things.
Right, exactly, and especially a lot of electronics and some infrastructure, and things like that, commercial buildings and other things that copper gets used.
Even the chip supply shortage is now turned into a glut. So there's a lot of stories that aren't being passed along on the popular media.
I think we always kind of felt that with chips, right? We're going to get to the point where you could pick up chips at the exit aisle at TJ Maxx eventually, right? So we're going to get there. And then while Congress is debating, $55 billion in support for the industry to keep a lot of it or encourage a lot of it here in the United States. We'll see whether they get any movement on that. But on the broader macro picture, though, I mean, we had we saw pretty clear inversion, right?
It got deep there for a few days. 15 bips or 13 bips between the 2 and 10-year yields.
Mm-hmm.
Yeah. If you hadn't looked at the CPI number or the PPI number this week, you would have thought and just looked at the way that treasuries are trading, the way that equities are trading and currencies, you'd say, oh, and commodities, of course, as we mentioned, you'd say, oh, this is a market freaking out about the growth outlook. And, as we've discussed, the idea that the Fed is going to be, overreactive to this inflation impulse and going to crush the, price pressures at the expense of the economy, driving a recession. That's the message. The idea now is that increasingly the markets are pricing in this concept that the cure may be worse than the disease, or if not worse than the disease, is going to be
causing the disease.
The cure is going to have some major economic downside associated with it. The inversion of the closely watched 2-10 segment of the Treasury yield curve. It's the deepest inversion we saw this week. That was the most notable financial market reaction after the CPI number came out. And that's the bond market telling you, okay, we think that the Fed is going to react very strenuously to this, and we think that the economy is going to suffer for it. And this is, if to take a positive view on it, the Fed's inflation fighting credibility sure looks pretty solid in financial markets. If you're pricing in recession.
Yeah, exactly. They seem to be believers, right?
Yeah. And
but they seem to be believers, but they're believers in inflation fighting, but there is a sense of an inevitability. I mean, I don't feel this way yet, at least, but I know that it's part of the narrative that's out there, that there's sort of an inevitability that they are committed to quashing inflation, and the inevitability is that we're going to see negative growth for some time because of it, and there's really no way around it. Now, I don't think that's true, but that's what I hear pretty consistently.
Yeah, I think that's right, and that's certainly the signal that's coming out of financial markets loud and clear. But one of the things that we did see this week after the CPI number, we saw some markets have stabilized into the second half of this week, and part of it, I think, is because the Fed messaging has gotten a little bit better here this week. When the first CPI number shocked to the upside, and there was this kind of panicked reaction, it seemed, and the Fed, after Chair Powell had ruled out essentially a 75 basis point rate hike, guess what? They were going 75. And it seemed like the market had put the same motif, in reaction to this number this week. But Fed governors have come out, even the hawks like St. Louis Fed President Bullard, Governor Waller have come out and said, hey, look, we're not just, essentially what they've said is, we're not going to be just, flapping in the breeze and reactive to every number. This is, not what we want to see in terms of CPI, but this is this is within the scope of the 50 to 75 basis point rate hike cadence that we are engendering and, that we are following here. Mm-hmm. And we're not going to be scared, by any given inflation number that surprises to the upside here isn't going to drive us off of our game plan. And I think that that's an important thing for them to say. And I think that has steadied nerves in financial markets, that the Feds, maybe their hand on the tiller is a little bit firmer and they're not just rudderless, getting blown into reacting to every CPI miss, because CPI is just one metric of inflation. Yes, it's a major metric of inflation. It gets all the headlines. The Fed is probably culpable to some extent in letting the narrative of, CPI be driven by headline CPI numbers. There's a reason that they focus on core PCE prices, which are 4.7% and trending downward. That's the one that they actually target. Yeah,
there actually was encouragement in the underlying numbers. Exactly. Of the headline, right, Brendan?
Yeah, and a lot of this CPI number was driven by rents and the housing component, where that's going to be a little sticky for a while. But we do also know that the housing market is slowing with higher rates. But when you look at the kind of underlying components, especially the stuff that has been up a lot during the pandemic, we're starting to see that disinflation start to seep through. And I think in the next couple reports, you actually could see very, very low headline CPI numbers with all the commodities coming off, and also used car prices coming off and things of that nature.
For sure. Yeah. And you're right that, housing can be pretty sticky in pricing because in a lot of cases you have contracts on
and also just the way they measure it, they do a rolling average, so it's not a hugely volatile number. It kind of goes in waves.
But that said, it doesn't have to. If it just has to stop rising, right?
Exactly.
Right, because we're measuring increases in speed.
The media is reporting the year-over-year numbers, which is perfectly fine because they're very headline grabbing. Mm-hmm. But really, what matters now is the month-over-month changes.
From a trading perspective, it's obviously very hard to build longs in this market, right? If you're an investor and you're saying, I want to look at some of these stocks, they're on sale, right? Yeah. I'm thinking about buying some stocks. You look into, every inflation number can potentially it's a very unstable platform to build longs on because you've got so many different inflation numbers. The markets have been reactive to every single one. The Fed hasn't narrowed its scope particularly well. We've got University of Michigan inflation expectations numbers coming out today. And that could be, something that moves the market. And so it's hard to, even if you're expecting, there's going to be an inflation peak, what did the markets do when there was an expectation of peaking inflation? They rallied in anticipation of that May CPI number, like 12%. The NASDAQ was up like 12% in a week and a half. Like the markets are itching to get that narrative into the picture for the bull case. Peak inflation and having the Fed rate hike expectations come off, moderate a little bit from like 3.75 at year end. If those come down to 3.5, 3.25, that's the kind of dynamic in the second half of the year that can really fuel some much better trading dynamics. We have to get there first. And, and if you're thinking about legging into some of these longs, you got to look at, what's the July CPI number going to look like, right? And the July Fed meeting is another big circle on the calendar. But it's important to remember that between the July 27th Fed meeting and the September 21st Fed meeting, there's a massive expanse of time. And so a lot can change in that period. So it's traders would probably want to get at least through the July Fed meeting, if not through July CPI numbers, to feel confident in trying to test the waters. Is it safe to get back in the water?
So before moving on, before moving ahead, because I want to take a break and then come back and talk earnings a little bit. But what's your call on the Fed right now? I mean, is it 75 or a full basis point?
We've been
a large number. I should say a large number. Yeah,
you certainly can't rule out a full percentage point because the Fed has been basically taking all of the rate hikes that the market has given them. And the futures markets kind of gave them 100 basis points. They didn't like it. Subsequent rhetoric by Waller and Bullard and so forth kind of pared that back. So now it looks like the markets are giving them 75. Our expectation is that at this point, 75 would look like a dovish surprise in July. And the Fed can get away with a 75 basis point. The fact that, a percentage point was on the table, 75 looks like it's kind of right down the fairway. And then they've got a 2-month period in which they can sit tight and they can, they don't have to change very much. They've got plenty of time to message and change the communications as needed. So 75 basis points is our expectation for the July meeting. And then beyond that, our difference from consensus is the subsequent meetings. We think that by the late September meeting, the macro conditions are going to look conducive to a 50 basis point rate hike. Sorry, not cut. We're not there yet. A 50 basis point rate.
Yeah. It's funny how 70. Yeah, look, if 75 is the biggest increase, which is feels like a relief, and then you get to September and you're talking about something that's not 75. Yeah, I mean it's that it's going to feel dovish, but it's also going to feel. I think there will be a lot of relief in the markets, and could absolutely spur a lot of activity. Let's come back and talk about a big bank earnings quickly. You're listening to the Macrocast.
Every 2 weeks, HBS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HBS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, back on the Macrocast. Guys, it's big bank earnings week, at least most of them this week. We had Citi and Wells Fargo today. We had JP Morgan. Who else did we have?
And then Morgan Stanley.
Yeah. Goldman's not till next week, I guess.
They kick it off at the beginning of the week.
Yeah. So JP Morgan was the big news, right? I mean, it was. I mean, we're seeing. To me, I see like two themes, with the exception of Citi that had an interesting report today. But one theme is loan loss provisioning, which we're definitely seeing, and then misses on overall earnings. But Brenda, can you talk to us about JP Morgan?
Yeah, so JP Morgan's always the first bank to report, and their CEO Jamie Dimon, he's a very intelligent person, so his insights are always valued. But he's also a funny, good speaker, so their earnings get a lot of attention, and this time it was justified. So JP Morgan is a very good bank, and their earnings weren't terrible, but they came in below expectations, and they did start to build reserves for future credit losses. They're not seeing a huge amount of stress, and we'll also have to remember we're coming from very, very, very low levels. But they took a kind of surprise decision to suspend their buybacks as they build some more capital. And in their outlook, they kind of had a bit of a dour outlook on the U.S. economy, which the market focused on yesterday. But today, actually, with Citi, they're just not really seeing the stress in their book. But also, it should be noted that Citi and JP Morgan have different books. Citi is much more of a global bank and a little less of a consumer bank than JP Morgan. Wells Fargo also started to build reserves, but they also mentioned that their consumer is doing quite well, and we're building it from low levels. But the economy is somewhat slowing. So the banks, are doing well. They're safe and healthy, but they're not. Higher rates generally is good for banks because they're able to increase their net interest margin, which is the difference between what they borrow and what they lend at. But with the economy kind of slowing, the higher rates are being offset by lower, especially mortgage demand. People just aren't taking out mortgages.
Yeah.
And then also you're going to have to build some reserves for what might not happen, but you want to be ahead of the curve to build it.
I just remember that all these banks had massive loan loss reserves going into COVID, which they eventually then just rolled off and contributed to profitability later. Yeah.
Not only did they not have to use those reserves, the loss rate actually decreased because we gave everybody a lot of money.
You can just tell, I mean, these are honestly, these are the smartest people in the world, truly, right? I mean, they have more access to data than we ever do, and it's one of the great economic stories of how everybody got the economics of COVID wrong. It's like I don't even think there are really those big short guys, right? Because they're everybody got housing and financial crisis wrong except for these guys who really got it right, and they eventually made a lot of money on it. I think no one really knew what was going to happen with COVID, and everybody was surprised.
No one predicted a housing boom in a global pandemic. And actually, back to your point, Jamie Dimon also kind of went out on a rant, which he's been making this point for a while, that the way that the Federal Reserve regulates the banks is they do an annual stress test where the Fed comes up with this one scenario of what the future is going to be like, and that's what the banks have to build their capital off of. And Jamie's point is that this is a really dumb way to regulate banks, that they run hundreds of scenarios every day on their book. So no one knows their book better than them. And to just have this one random, scenario, and then that's what we're going to, build our capital off of is a very inefficient and also expensive way to regulate banks.
One of the other points that Jamie Dimon and other commentators have made is that this is a really very challenging to interpret current scenario. Not only did people get COVID economics wrong, but the current scenario is, consumers, every metric of consumer confidence is in the toilet. And, what did we get? We got retail sales spending was like really solid.
And all the banks have said, the consumer is still kind of flush with cash and doing fine. We're worried about the future, but the current situation is a strong consumer still.
I don't know what they reflect. Honestly, just look at it and you say, we are at 3.6% unemployment. Like, employment is holding up, and wage gains are mostly going to people with the highest propensity to spend.
Yeah.
So, like, I don't know. It seems to me, just if you just look at some of those like big kinds of metrics, I don't feel like people should be surprised much at this right now.
Well, there are lots of cross currents, and Bank of America has great, as you said, Tony. They have such incredible data on retail spending and that sort of thing. They came out with their forecasts, and what they were seeing in their like very contemporary and real time spending was estimated, X autos and gas, a pretty dismal retail sales amount. You can argue that like Bank of America's data may actually be better than the official one that they publish. But this is there's so many cross currents. It's very confusing. And I think that is, when you have the Fed messaging about growth, you've obviously had much more on the positive side, discussing how resilient the U.S. economy will be to rate hikes, that conceding that yes, their rate hikes and inflation fight will slow growth, but that this is an economy that is well placed to absorb that kind of blow. And I think that the question sort of falls to, how long does it go on? Is the consumer sort of like a boxer that is, out there swinging, but in the later rounds, it's just kind of taken so much body work that they eventually start to tire out and start hitting the ropes. That's kind of the,
when there is a limit. Yeah, there is a limit.
And so when you look at the the interest rate futures, Fed fund futures market, the expectation is the Fed is going to hike very aggressively into year end. Rate hikes are going to stop at the end of this year, and then they're going to start cutting in the spring, summer of next year, which is essentially the market saying to the Fed, you're going to make a mistake. You're going to over tighten, and you're going to have to reverse yourself. You're going to oversteer into this and oversteer into that, and the economy is going to suffer for it. And that's, I think that obviously the Fed knows full well this motif in the markets, and our expectation is that they are going to be increasingly sensitive to these balanced risks as growth. And we're talking about, not just U.S. growth, we're talking about global growth. We got some growth data from China overnight that looked pretty awful. And
they were in lockdown. Was it worse than you expected?
No, well, it's always a question of reality versus what they actually publish. Right.
Good point. That's a great point.
So there is a factor there that you have to build in into those data. So, it's pretty clear that that the zero COVID lockdowns are a big problem. European growth has held up better than it. We'll talk a little bit more about Europe, but European growth has held up better than anybody expected. But it's hard to look at China and say that economy is ready to take off. It's really hard to look at Europe and say they're going to hang in there for the long haul. Their growth has been resilient for the last 2 quarters and it's going to stay resilient. That's a little bit hard to imagine.
The key, I can't help feeling just in the case of China, where it really, really is self-inflicted. And as much as we've, if you want to say, one of the, worst exports from China was COVID. Okay. But it's still an export from China in the sense that because they're dealing with it so poorly, and they keep doing successive shutdowns, that they're still exporting COVID to the rest of the world, not in the form of the virus, but in form of one of the knock-on effects of the virus that they're exporting to the world, which is supply chain problems that they are now they are not no longer a reliable supplier of goods, and that's a problem for the global economy, because they have for 20 years have been a very reliable supplier to the global economy. I want to talk about Europe. Let's take a quick break and come back. You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, back on the Macrocast, brought to you by Markets Policy Partners and Hamilton Place Strategies. Guys, the dollar is so strong against the euro that we could probably buy what? Crete? What can we buy? Like Sardinia? Can we buy Sardinia? I mean, it's a good deal right now, right?
Plan your European vacation now.
Yeah, we got to parity. We got to parity. I think it's back above. I think euro's recovered a bit to get back above parity, but parity with the dollar again, which you hadn't seen in a long time. I kind of just look at this and say, well, it's the yields are what's happening. I mean, yes, I think the European economy, you said in the last segment, John, that it's held up better than people expected. I think that's true. They have hits to come that we know. We know it's going to be a challenging winter for Europe going forward. The policy responses that they have are imperfect. But at the same time, I mean, we're raising rates pretty rapidly, and they're not there yet. And is that where you see fueling dollar strength, or is it more than that?
Yeah, it's certainly part of it. A big part of it, the central bank divergence. The ECB has a meeting next week that's going to be very interesting. The expectation is that they do, and they have signaled that they are going to kick it off. There was a sense that perhaps the Northern European hawks were going to grab the wheel and drive toward a 50 basis point kickoff, but it looks like they're going to do 25. And this is, in the midst of some very challenging, obviously, they're on the front lines of this stagflationary risk, and with the war right at their doorstep in Ukraine, it's a really adverse situation for them. The President Lagarde of the ECB has been very much more vocal than the Fed about the balanced risks of growth and inflation. They've characterized the inflationary impulse in much more in supply shock terms, and I think it's clearer. It's clearer there than it is here, although it applies here as well. And then they have the periphery to worry about. We'll talk a little bit more about Italy. They've got this very fragile balance that they have to strike of battling inflation that, to a great extent, they clearly know they can't do anything about, natural gas prices, oil prices, and so forth with policy, while trying to keep the peripheral debt markets on side while, while being sensitive to growth. So President Lagarde is and managing a pretty fractious, still north-south split in the ECB, the Hawks versus the Doves, and now we have the Italian political drama coming back, making their lives very difficult. Just as it seemed as though the concept of an anti-fragmentation program, which would be, central to keeping this all together, is still on the drawing board essentially, and it just makes for pretty high stakes next week.
Yes, I mean shifting to Italy. Super Mario. It's a tough week for him. I mean, he tried to quit, can't quit, like the Hotel California, but the coalition is falling apart because of Cinque Stelle, the 5-star movement, and former Prime Minister Conte, sort of breaking apart the coalition there. It's the last thing that Europe needed right now. Certainly, Italy doesn't need this right now. He's, in my opinion, I think, probably the most competent and accomplished technical policymaker in Europe is Mario Draghi, and they're lucky to have him. And but Italy's always going to make things hard, aren't they?
Yes, no question about it. It seems as though, the idea of a snap election in the summer in Italy, when like 5-star, as I'm led to believe, is not particularly popular in the polls these days, and when essentially markets have not responded, with total equanimity to this. Obviously, the euro is very low, but it hasn't.
We've seen some spread. We've seen some spread on German between right,
but it hasn't. It hasn't blown out.
Not a blown out. Yeah.
And so the expectation is, as your baseline always has to be, don't bet against Super Mario. There's drama in Italian politics is nothing new. Brinksmanship is the way things work over there. The idea that his coalition partners would relish a snap election. He's kind of got the whip hand potentially with that, and if he has credible threat of that on his side, maybe they can bang enough heads together and make enough concessions. But he's dealing with a very very challenging coalition arrangement, and so we'll see how it works out. Next week is going to be, again with the ECB meeting and this pivotal reformation of the coalition. It could all be, the markets are not panicking about this right now. And
I just always feel like, I feel like, I just talked to Matthew, our producer. I always feel like we should be playing like La Traviata in the background. So I always be like, it's operatic whenever we talk about Italy. We should always have opera playing in the background when we do a segment on Italy, because it's always operatic drama in how things get resolved on the Italian boot.
Yes, and so right now the spread, the Italian 10-year yield to German 10-year yield isn't it's off of its wides before the announcement of the anti-fragmentation push. And last time we looked, the 10-year yield in Italy is still well off. It was above 4% and rising not too long ago, and is now in the low 3% and relatively stable. So and it can all next week can change things a lot. Details on anti-fragmentation, the way that the messaging around a rate hike happens, and of course the coalition dynamics in Italy. So watch this space. But so far, Mario is keeping his cape.
Good.
Mario is keeping his cape on.
Brandon, what are we looking at next week?
So Turkey, Russia, the ECB, and China all have interest rate decisions to make, and then we'll get the global PMI data. So that'll be an interesting macro week.
Earnings come out too, or earnings keep rolling. We've got Bank of America and Goldman Sachs are the banks that come out on Monday, and we've got some tech as well. We've got Netflix, Twitter, Snap. We've got some, the logistics of CSX, and some consumer stuff with Harley.
It's an interesting week. Yeah, that's an interesting cross section week of firms actually really to look at. You have Twitter. I think Twitter in court next week also. I can't remember. I think I said.
Oh yeah, yep.
Yeah, right. Twitter court date. So we'll get to see that too. So it should be fun. It should be a fun week.
Hot summer.
Yeah, exactly. All right, guys. Great show. Have a fantastic weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.